Okay, so thank you very much. You are welcome to our lecture one of the regulatory framework. I am Mr. Mwanza and I should be able to take you through this course. So I think I don't know if I have already shared, but really your course outline has got a couple of topics. The first one is just to have a look and overview of at the overview of the financial system, which we are already aware of, because remember that the financial system, ideally comprise of the financial institutions, the financial markets, and the instruments as well as the regulatory framework. So the framework is now what we are discussing here. So in other courses, bank operations, money banking, and financial markets, we have we have tried our best to to really just look at these different financial institutions and different markets and instruments. Now we are saying, okay, what about the regulatory framework? How does it work so that we ensure that there is less bias? I mean, there is less chaos, right, in this space. And this is very important because, as we have always been arguing, if we do not take care of the financial system, i.e. through regulations, a lot of things can go wrong. And examples include the different financial crises that have taken place over time. 2008 was bad. Okay, the Great Depression of, is it 1928, was terrible. So we need to take care of this financial system, because especially that there is a risk called systemic risk, i.e. that the industrial risk might affect all the the companies or the entities in the market. Okay, that is fine. So usually the way I liken regulations, I know it looks like regulations is the enemy, but what you discover is that similar to the way we have traffic rules, right? So we have got the traffic signs, the speed limits. Okay, now those things are not there to make us stop moving, no, right? Those things, or the traffic rules, are there for to ensure that there's safety, okay, and that different road users are basically protected. In other words, regulation is for our own good, right? As a company, as a market, okay, it is for our own good, but it is also for the good of the various stakeholders that are interested in our entity. So we'll look at that. So we'll look at the overview of the financial system. We'll look at regulation, the regulator, the different regulators themselves, the Bank of Zambia, Securities and Exchange Commission, PIA, okay, regulations of financial markets, regulations of financial institutions, regulations of pension, and so on and so forth. So it is basically the regulatory framework. We'll borrow a lot of information from the different acts in Zambia, okay. The Banking and Financial Services Act is one of those acts that are going to be guiding us. So it will be an interesting course, not very difficult, but it's something that we can manage. Okay, so just as we said, so we're just looking at the overview of the financial system. So remember what we said, that the financial system really of any country or any economy comprise of the institutions, the regulatory framework, and the market infrastructure. But what is key here is that the financial system has a very unique but critical role, okay, of ensuring that there is efficient movement of financial resources from individuals, okay, who have it in excess, to individuals who have it in deficit. I think this part we have already explained in most of these courses that we have done previously, but this is very critical, for our economy, that there is efficient movement of resources. Okay, so in other words, what we are saying is that there's this channeling of savings so that we can convert the savings into investments. It is always important that savings, okay, basically result into investments, especially now that we are looking at the need for production. The answer to most of our problems really is for us to produce. As Zambia, we need to produce. If we can produce, we'll be able to cover the issue of inflation, because remember, if we are self-sustaining, okay, we are producing enough goods, it means that prices will definitely stabilize and might go down, because we are producing and we are self-reliant. We are not importing so much and so on. Okay, other than that, if we produce, then it means that our imports will be reduced, right? Again, because of self-reliance, a lot of things are being produced from within, so we won't want to get juice from outside. We won't want to get tomato sauce from outside. We don't want to get a bicycle from outside, because we are producing from within. And so if we can do that, then we are avoiding the issue of import inflation, which is an inflation that comes as a result of our heavy reliance on imports. But also our exchange rate might improve, because if we are exporting, we have enough and we are exporting, then people would demand the kwacha to buy the goods that we are producing. Okay, so in that regard, then it means that the kwacha will gain value, and that is basically appreciation of the kwacha. So most of these macroeconomic variables can be dealt with if we focus on production. We need to produce. Every entity, every individual in Zambia has to be seen to produce serious production and value addition, right? That is the only way out for us, and this has to be driven by private sector. Okay, not so much government, but private sector driven. So SMEs, all those things, right? Okay, that is fine, but at least we already appreciate that. We may have already discussed that in one of these previous classes. Let me now bring your attention to a revision of financial markets and instruments. Remember that financial markets simply is an economic relationship between buyers and sellers, right? Similar to what happens at Chisokone, only that for the goods market, usually they are physical, and you go there, you buy your vegetables and whatever. It is tangible, right? The products that are being sold are tangible, right? As opposed to financial markets, where of course we are bringing buyers and sellers together, but then the assets involved or the products involved are intangible because they are financial instruments, right? So basically a situation where we are bringing buyers and sellers together of financial instruments, that is a financial market. And we know that examples include the Lusaka Stock Exchange, Bank of Zambia, and so on and so forth. Okay, that is fine. Other than that, of course, we have the financial instruments that we have been talking about previously. Okay, remember that a financial instrument is simply a promise to deliver payment at a specified time, in the future, under specified circumstances. So on the part of the issuer, or on the part of the borrower, a financial instrument is a promise that I will pay you in the future. But on the part of the investor or the lender, what we are saying is that a financial instrument, okay, is obviously an intangible instrument, where someone decides to invest some money with the hope that they will receive some payments in the future. Okay, or in other words, it is a claim on the future assets or profits of the issuer. Okay, so basically the different types of instruments we already know. We have got debt instruments such as bonds, such as loans. We have got equity instruments such as shares, and so on and so forth, right? But we also have derivatives products as well that we'll discuss definitely in this course. Okay, now what about financial market participants? Again, this is just revision. We know that financial market participants include households. Okay, they include businesses. They include the central bank like the Bank of Zambia and their agents, as well as the international financial organizations and regulators. So remember, we are not operating in isolation. There is an international market out there that we need to relate with. So all those are participants, and even when it comes to regulation, there should be some kind of like alignment with what is prevailing, at the international stage. So we'll be able to look at that as well. Financial institutions, right? Again, here this is revision. Financial institutions can be classified by the assets they provide. By the services they provide. This is critical. So services provided, for example, if you look at deposit taking institutions, this is where we have commercial banks. So deposit taking institutions are common for accepting deposits from customers and creating an asset called a loan, and then basically benefit from the interest rate differential, right? So commercial banks are one of them, credit unions are one of them, savings and deposit institutions are also one of them, and so on and so forth. We also have in financial institutions that fall in the risk pooling category, such as insurance companies. I think this one is a no-brainer. Okay, insurance companies are common for that. Contractual savings as well. This is where we have pension houses and so on. So basically, we are encouraging people to save. Okay, and then obviously we already know how pension operates or pension works. Okay, ideally it is asking for people, okay, to make contributions during their time of employment, and then at the time of their retirement or when they are declared redundant, they can have a claim of their contributions plus interest. So those are contractual savings, very important. Market makers, I think we have brokers, dealers, very critical here. And then, of course, specialized sectorial financiers and just general finance providers. So that is just a revision, and I know that we already have information around here. Okay. Just something that you can look at in your own time, especially as we kind of like summarize the financial institutions, the categories and their core functions, right? So you can have a look at that in your own time. Okay, so we do have some boundaries between different financial institutions, but of course, due to how things are evolving, how things are changing, it seems that the barrier, okay, between different types of financial institutions as we know them, the barrier is increasingly becoming blurred. Okay, in the notes we are saying because competition is growing, institutions are engaging in each other's activities. So this is true. So you find a commercial bank has got a product which deals with insurance, right? Again, that is because of competition, because people are saying, okay, fine, I'm banking with you, but I also have insurance need. Okay, and so you find that we package it so that it can become a one-stop shop. Someone can find their leasing products, they can find their insurance products, they can find their savings products, and so on and so forth. So it turns out that the demarcation or the boundary is getting blurry. Okay. But what we are saying is that the demarcations are critical, because that is what is helping regulators with their regulation. So we know that banks are into this kind of business, and this is how much regulation will be able to give them. So much as they are becoming blurry, but they are still very, very, very important. Okay, they are still very, very okay. So moving on, we also have a situation where we can classify financial instruments into two categories. So we have got, financial financial systems being classified into two categories. Okay, so please, this is not instruments. This is not instruments. It's supposed to be in the financial system. Okay, the financial system. Okay. Okay. So anyway, we're looking at the financial system being classified into two categories. So ideally, we have the finance side, okay, of the financial system, which involves the one-way movement of resources, with the second one being dependent on a condition, right? So examples that we have there is the way insurance operates. So you find that insurance, when you are paying your premiums, that movement is guaranteed. So you take your money to the insurance company, the insurance company gets a hold of your money, but for you to get your money back, it is on condition that something bad happens to you. So that is what is happening on the finance side of the financial system. But when you look at the credit side of the financial system, you find that there is a two-way movement of resources, i.e., you get maybe a loan from the bank, and so the bank gives you a principal amount. The second movement of you paying back is guaranteed. You just have to pay. There are no conditions, there are no excuses. You just have to pay. So that is the credit, side, of the financial institution. So just a summary of what I talked about in terms of the finance side and the credit side. Okay, we talked about it. So examples and instruments are provided, as well as the participants and the regulators. Okay, so as an introduction, I think this is what we can do. We'll be able to have one or two other interactions where we do the usual Google Meet and so on. But for now, I just wanted you to have some kind of foundation or background to what we are doing. So we'll quickly revise around financial institutions and financial markets in our next class, and then we should be okay. So for now, thank you so much. We'll meet in session 2.